Good afternoon, advisors, and welcome to the 8th webinar of our 2014 series, Insurance by the Numbers, where we're focusing on a different number each month from 0 through 10, and how those numbers impact your clients in the insurance world. This month, we focus on the number 7 and the fact that long-term care is expected to be $700,000 for 3 years of care 30 years from now. Our presentation today will last between 50 and 60 minutes, and you must be logged in for at least 50 minutes from the email address you registered with to qualify for the CFPCE credits. If you have questions as we go along today, feel free to ask them on screen, and we'll do our best to answer them timely and anonymously. This webinar is being recorded and will be posted to our website within about a week. Your presenter today is Jill MacNeil. She's our long-term care specialist, and she keeps up on the latest and greatest in this changing market. Please welcome Jill MacNeil.
Good afternoon, everybody, and welcome to our monthly seminar, or webinar, I apologize. Are your clients prepared? Are they prepared for a possible $700,000 cost in 30 years for their long-term care? Today we're going to talk about this $700,000 number, whether they should self-insure or purchase a long-term care policy. Then we're going to talk about those policy choices that they have if they decide they want to pursue a long-term care policy. And I'm going to show you some statistics about females and why it's important for females to plan for their possible long-term care. We're talking about single females and married females. Rate increases. The long-term care industry, for some reason, has received a bad press or bad rep because of rate increases. And we're going to talk about this and show you how rate increases really are a fact of life. And then I'm going to end up by talking about changes in the industry. As Dina said, there's always changes in this industry, and we'll bring you up on the latest changes. Now, when you sit down to talk to your clients about long-term care, there's several questions that you can ask them to get them thinking in the frame of mind. Are they planning for their future? Ask them what worries them most. Talk to them about what their concerns are and see if you can put those concerns to rest or plan for those concerns. Ask them, how do you see yourself in 20 years? In 20 years, maybe they're going to be 75. Do they see themselves as still living in their own home and being independent? Maybe in 30 years. At that time, if they're 80, 85, they may need to move into an assisted living facility. And have they planned for that? Do they have money set aside for that? Or maybe they want to see themselves still in their own home, but at that point they may need some care or some assistance, and they also need to plan for that. Are they concerned about living too long and becoming a burden on their family? They may have seen friends or family members go through this and seen them become burdens on their families, and maybe that's a concern of your clients. They don't want to get to that situation, so hopefully they're planning for that. Ask them, is it important to them where they receive care? Do they want to have choices in that? Do they want to, as we talked about, receive care in their home? Are they planning for that? Or do they care if they become dependent on Medicaid and then have no choice where they end up receiving care, or what facility, Medicaid facility that they're placed in? They may be placed in a facility that is not close to their home or their family. And a lot of your clients probably still think that Medicare will cover their long-term care needs. Make them aware that Medicare is not a good alternative. Medicare will only pay for the first 100 days under certain conditions. If they've decided that they want to self-insure, ask them what assets would they be willing to cash in to pay for their long-term care. Get them thinking about what investments they don't mind seeing go away. Talk to them about how that may affect their retirement plans if they have to tap into their assets. So hopefully after you've asked them all these questions, they're going to stop and think a minute and say, well, gosh, maybe we've never thought about things that way. So get them thinking down the lines of the future and their plans. So now that we've talked about that a little bit, let's look at this $700,000 number that's projected cost for long-term care for 3 years of care and 30 years. Do your clients want to self-insure, or do they want to purchase a long-term care policy? Let's look at the different options or the different pros and cons of each. If they've decided they want to self-insure, and we want to try and reach that goal of having $700,000 set aside in 30 years for that need, they would have to save $12,481 annually. And if that money received 4% interest, and we're being generous here in this low-interest environment, in 30 years they would have saved that goal of $700,000. Versus if they decided maybe to purchase a long-term care policy, they could achieve that goal. Again, same kind of goal, obtaining a pool of and here we want to obtain a pool of long-term care benefits in 30 years of $700,000. So in order to do that, let's look at Jim. Today, he's age 55. If he purchased a long-term care policy today with a daily benefit of $265, and he had the 3% compound inflation rider on that policy, so that means that benefit of $265 would grow by 3% annually and compounded. Policy with a 3-year benefit period. In 30 years, that daily benefit would have grown to $639. Again, with that 3% compound, it would have grown $639 a day. So his pool of benefits, his long-term care pool of benefits, would be calculated by taking that $639, multiplying it by 3 years, or 1,095 days. His total pool of benefits would be the $699,705. Not exactly the $700,000, but very close. And a policy today for those benefits would have a premium of $3,206 for Jim. Okay. Now let's compare these side by side and look at the out-of-pocket expenses for each way of saving. If they were to self-insure, as I said, put $12,481 away every year for 30 years, it would have cost them, or their expenditure, or their out-of-pocket expenses, $374,430. Compared to that long-term care policy of paying the premium of $3,206 for 30 years, they would have spent $96,180 over the 30 years. Now, I realize that the self-insure has many benefits to it because they would have that pool of money set aside, and if they don't need the long-term care services, they would have that pool of money to leave to their heirs. But think about this. Are your clients disciplined enough to save $12,481 every year? It takes a lot of discipline because remember, those are untouchable savings. They couldn't touch that pool of money because the thought is if they need it, chances are they're not going to need it until their later years of life when they probably need the long-term care. So again, are your clients disciplined enough to leave that alone and not be tempted to touch it for maybe a retirement home or doing some nice travel, or maybe even use it to help fund their grandchildren's college education? And maybe some of you are looking at that long-term care policy and thinking, well, that's nice if the premium now is only $32,000, but what happens if they have rate increase down the line? Well, it would take a rate increase of 289% on day one for the long-term care for the expenditures to be equal. So quite a bit of different, as I said, pros and cons to both. But I want to just make sure your clients are thinking that way because by planning for the future, you're really planning to take care of your family. Your clients are really not so much concerned about taking care of themselves, but thinking about their family because a long-term care event really impacts the whole family. The care providers, which usually end up being the spouse or son or daughter. So a long-term care event really affects the care providers. And when Genworth did their 2014 cost of care survey this year, they interviewed a group of care providers, and these are some statistics that these care providers came up with, or that they obtained from these care providers. 65% of them said they missed work. They were working fewer hours. They were pretty late. Some of them even had to change career. 46% of them saying that providing the care impacted their personal health and well-being. And I could certainly see how that would affect a care provider, especially if it's a spouse, because chances are that spouse is elderly also. So the extra care of providing for the unwell spouse would be very emotionally draining, and also it would affect them physically. 53% said they had a lost income due to the demands of providing care. So that goes right up with the one above where 65% said they missed work. So you're going to have less income. The average hours per week spent providing care was 21 hours. So that's a lot of time taken away from the care provider's own personal life. As a result, 37% that it negatively affected their partnerships or their relationships with their spouse or partners. So again, when you're talking to your clients about planning for the future, maybe purchasing a long-term care policy, stress how they're really doing it not only for themselves, but for their family members. Because you want to let your daughter be a daughter. And I say that not so much as let your son be a son, but that's true also. But it's been shown that daughters provide about 50% more care than sons. Let your spouse be a spouse, not a caregiver. Again, it really impacts the whole family when somebody needs care for a long period of time. Now let's talk about policy choices. So if your client has decided they want to pursue a long-term care policy, there's several choices they can make. Or maybe your client has said, well, we don't want to look at a long-term care policy because we've heard that they're very expensive. Maybe they've talked to friends or family members that said, oh, yes, they're very expensive. The policy can be expensive, but there's a lot of choices and variances and differences in benefits that you can use. So I want to show you here how we could adjust a policy for your client's needs and their budget. So for example here, we're going to take Tom and Susan, both age 55. They live in Pennsylvania, where the cost of a private room in a nursing home is $295 a day. So if they wanted what we would call a Cadillac policy, a top of the line, a very rich policy, very comprehensive, and we've nicknamed it Cadillac just because we're trying to do a little comparison here, and we're using car names to sort of give you the idea of different types of policies. So in this example, if they want a top-of-the-line policy, we'd recommend the daily benefit of $295, 100% of the cost of care, 5% compound inflation, so the benefit would grow by 5% every year, compounded. Benefit period, 5 years with shared care. So that's really 10 years of care to share between them. Elimination period of 90 days. We use the 90-day elimination period because many of you advisors have told us that you recommend their clients have at least a 3-month emergency fund. Okay? This policy would have an annual premium of $18,751. So yes, this is a very expensive policy, but again, this is a top-of-the-line policy. Years ago, or not so long ago, in the last 2 years ago or more, we sold quite a few policies with similar benefits. The 5% compound we highly recommended for younger clients in their 40s and 50s and early 60s. But nowadays, with different changes in the industry, the 5% compound inflation policies have become very expensive. But just to give you an idea how the inflation option impacts the premium, let me show you the same policy. If we changed it to 3% compound inflation, the annual premium goes down to $9,690, so almost half the premium just by changing that compound inflation option. Okay, so if your client doesn't want this top-of-the-line policy or doesn't need it, maybe they have a lot of assets put aside and they just sort of need a nice policy, but maybe not one quite as rich as that, sort of a good, basic, solid policy like a Nissan car. So in this example, we'd recommend a daily benefit of $240. And we achieved that $240 or arrived at that $240 based on what we call our 80% rule. So as I said earlier, the cost of care for a private room in Pennsylvania is $295. That $295 includes the cost of food and other essentials that your client probably already has in their budget. So about 80% of that number is what it would cost them out of pocket for the nursing home. So we'd recommend the $240 a day, and we'd go down to 3% compound inflation. The 3% still keeps the policy growing. It may not, it obviously doesn't grow as fast as the 5%, but it still keeps it growing, and it qualifies for partnership policies in most states. So again, it's still a nice benefit. We dropped the benefit period down to 3 years with the shared care. The reports have shown that the average length of stay in a nursing home is just under 3 years. So with 6 years to share between them, there's a good chance that it would cover most of their costs. Hopefully they won't both need over 3 years in the nursing home. Okay, so you have a little bit of give and take there. We'd keep with the 90-day elimination period, and this policy would have an annual premium of $6,091. Okay, again, a nice medium policy, and not really so much medium, almost tending to go towards the good chance of covering all the costs. But if this is still out of your client's budget, we could go down to what we are now calling, or what we've nicknamed the Scion policy. Again, a nice policy with a little lower benefits. Here we'd recommend the daily benefit of $150, approximately about half their cost. And for inflation, we would add on the future purchase option instead of the automatic compound inflation like the 3 or 5%. The future purchase option gives them the opportunity to increase their coverage every 3 years without having to go through underwriting. It costs very little to put that on your policy. Okay, and then here we go down to a 2-year benefit period with the shared care, so this gives them 4 years to share between them. May not cover all their expenses, but a good chance it would cover the large majority. Keep the 90-day elimination period, and this policy has an annual premium of $3,427. So as you can see, as you look across the 3 different policies, there's a big difference in premiums. So you can design a policy for your client's budget. And here I just wanted to give you an idea of the variances in prices. So your client doesn't need to be scared away thinking right off the bat that they can't afford a policy. Here I wanted to talk about the different types of shared care policy options. Since we're talking about different types of policies, shared care is a rider that we highly recommend for our our clients that are couples. And when I talk about couples, I don't necessarily mean traditional married couples. I do mean traditional married couples, but I'm also meaning same-sex couples or common law couples. The rule here is with the insurance companies is if the same-sex or common law couples can prove that they've lived together 3 years or more, shared a home and expenses, they could qualify for the shared care policy or qualify for a couple's discount. So the first type of shared care policy, the one that's most common, which most of the companies use, allows them to share their total coverage. So in this example, if they had a policy of a $200 a day daily benefit for 3 years, they would each have, if they had individual policies, a pool of $219,000. Husband has $219,000, wife has $219,000. They add the shared care rider onto the policy, then it becomes a joint pool of $438,000. With one company, if they have this type of shared care policy, they have a joint waiver premium. So if one partner or spouse goes on claim, the premiums are waived for both of them. Also with the same company, if one partner uses all the benefits, the other partner is guaranteed to have at least 50% of their original benefit. So it would be 50% of that $219,000. Next type of shared care policy offered by one of the companies we work with is similar to the first type, where they'd each have their own pool of benefits. David and Lisa would each have their pool of $219,000, and when you add on the shared care rider, they can share the benefits. But this company requires that they each save 1 year for themselves. So $73,000 in this case. So if David became sick and went on claim, he could use his whole $219,000 of benefits. But in Lisa's pool, they'd have to save $73,000 for Lisa to use on her own. So the total pool that David could use would be $365,000. The third type of shared care policy is where it adds a third pool of benefits. So again, David would have his pool, Lisa would have her pool, and by adding on the shared care rider, they have a third pool of $219,000. So in this example, if David became sick and went through his pool of benefits, he would tap into that third pool of $219,000, leaving Lisa with her own pool of benefits. So this type of policy costs more than the other type of shared care policies, but you are getting more benefits. Just a moment, please. I have a question that I wanted to review and see if I can answer it quickly. I had a question there that, that asked if you have a shared care policy, if both spouses use their full benefits, would that mean there'd be a total benefit of $637,000? I'm not sure which example you're talking about, but if you're talking about the first one, no, they don't have that total pool. The total pool they'd have, if they both, the total pool they have to use between them is 438,000. Okay, so it doesn't multiply the pool. So, I'm sorry, I'm getting a little overwhelming with all the questions coming in. So at the end of it, I will try to take more questions. I did have a question right now asking about state partnerships and how the state partnerships protect assets. I don't have any slides talking about these state partnerships, so I'll just take a moment briefly to talk about it. The partnership policies have come about as a result of the individual insurance companies and the states getting together to develop these partnership policies. They're trying to encourage people to take care of their own long-term care needs and buy these policies so they don't become as dependent on Medicaid. So if your client purchases a partnership policy, they can protect more assets if they ever apply for Medicaid. They can protect more assets in the asset spend down review. So for example, if your client purchases a policy with $300,000 of benefits, they use the policy and then eventually apply for Medicaid. During that asset spend down review, they can protect an additional $300,000 in benefits, equal to the amount that they've received in benefits from their policy. Normally, when you apply for Medicaid, you can only protect about $2,000 in benefits in your own home. It varies by state. But again, these partnership policies have been developed to help you protect more assets, and not every policy is partnership approved, so the company has to get their policy partnership approved, and in order to qualify, the policy has to have certain inflation options depending on age. I think it's age 60 and younger, they have to have a compound inflation on the policy. If it's, I'm sorry, 61 and younger, compound inflation. If the client's over 61, they have to just have some form of inflation on the policy. And I believe it's 75 and older, they don't have to have any inflation on the policy. One more question I'll take right now. It says, do most companies provide each kind of shared care policy, or does this vary among insurance companies? The answer is the insurance company, no. The insurance companies do not provide all these different types of shared care policies. Each company has their own type. So for example, Genworth has the first type that I showed you. Mass Mutual has the third type. Mutual of Omaha has the second type. So each company just has one type of shared care policy. And I just wanted to show you the different examples here. So when you're looking at policies for your clients, maybe they're considering a new policy or something that they have, make sure you're aware that there are the different types of policies. Okay, let's move on here. I'll take some more questions later, but let's move on here a little bit. Now let's talk about females in long-term care. You're all aware, and most of us are all aware, that it's very important for a single female to plan for the future, because there may not be anybody living with her or nearby to help take care of her when she needs, or if she needs, long-term care in the future. But it's also very important for married women to consider this, or to plan for the future. And here's some statistics to show why that's so important. 1 million women become widows every year. That's a lot of widows every year. And this statistic is a statistic that really surprised me. I was surprised at the young age. So what it says is 59 is the average age a wife becomes a widow. 70% of baby boomer women will outlive their husbands. 80% of women are single at death. So as I said, a lot of times when you talk to your clients and they're married, it's a married couple, the woman will be, I'm married now, my husband will help take care of me. But chances are, in their elderly years, when they really need care, they're going to be alone. There's a good chance they're going to be alone. So they need to plan for that. And when you're designing a policy for a married couple, there's several different things to look at, several features to look at, and things to take into consideration. When we're designing a policy for a single female, it's pretty straightforward. Just look at the cost of care in her area and what her needs are. But here I want to show you some different things to consider when looking at a policy for a married lady. As I mentioned earlier, we think shared care policies are a very good option for married couples, or not so much married couples, just couples. Could be same-sex or could be common law couples. But the benefit, as I talked about earlier, good chance that a woman's going to be alone in the future. So again, we really like the shared care policy for the benefits, the extra benefits it may provide for the woman. So if they have, if they have a shared care policy now, they both have their own benefits and they both have their premiums. Again, they can share those benefits, but let's say the husband passes away. What happens? The woman then has her own benefits plus the husband's benefits, and his premium drops off, and she just has to pay the premium for her policy. So she gets her benefits plus any unused benefits of the husband's, her own premium, his premium drops off, and with most companies, the premium for that shared care rider also drops off. So they're no longer paying for that shared care rider, but she still has the benefits of it. So we think this, when you're, again, considering a policy for a couple or two people living together, this is very important to look at. So for example, we're going to consider Sharon, age 57. She lives in Kansas City, where the cost of care there is $175 a day. If we were looking at a policy just for her, we'd recommend that $175 a day, 90-day elimination period, 4-year benefit, and going a little longer than if we were looking at a couple of 4 years. Again, average length of stay in a nursing home is 3 years, but many people receive care in their home first. So this would provide that extra period of time if they need care, if she needs care in her home first. 3% compound inflation. This policy would have an annual premium of $3,645. Well, we showed them that, but we'd also suggest to consider a small policy for the husband. And by adding the small, add the small policy for the husband, Mike, age 57. So let's look at if we were to add the shared care policy for the husband. And when you add shared care rider onto a policy, the benefits have to be the same for each of them. So for Mike, we'd look at $175 a day, 90-day elimination period. But here we'd go down, when we're adding the shared care, we'd go from the 4-year that we showed for Sharon down to a 3-year benefit period. So it's almost 6 years to share between them. Again, it depends on the company how the shared policy is really works, but it's basically 6 years to share between them. Okay, and then that would with the 3% compound inflation, so this policy would have a combined annual premium of $4,681. So only about $1,000 more to add a policy on for Mike, because Mike may need the policy also in the future, and if he doesn't, or if he doesn't use all the benefits and predeceases Sharon, then she gets his benefits and her benefits, or vice versa. If Sharon predeceases Mike, and Mike has all the benefits. Okay? All right. Now what happens when the husband decides he doesn't want a policy? A lot of times the males will say, oh, I don't need a policy. My wife's going to take care of me. I'll probably die before her, and she'll take care of me. I don't need that policy. So in this situation, we would show Sharon the same benefits, the same policy that we showed before, the $175 a day, 4-year annual premium of $36.80. But if we added Mike on and added on a small policy for him, now I'm not talking about a shared care policy here. I'm just talking about a very minimal policy for Mike. So $50 a day, that's the minimum daily benefit allowed. The longest elimination period available, $365 days. The shortest benefit period, 2 years, and no inflation rider. The reason we're doing this, adding the small policy on for Mike, is so that Sharon would receive the couple's discount. So by adding this small policy on, they both receive the couple's discount. The annual combined premium is now $3,212, a saving of over $400. This used to work better earlier on before rates changed and everything, but it still works, and they're still saving $400 a year every year, and Mike gets a small policy. So it's a win-win situation. Okay. And this also works well if the husband already has a long-term care policy through work. Say may have a long-term care policy and they know they need a policy for the wife. So even if the husband adds on this small policy, he can keep the group policy but add on this small individual policy. Just had a question come in and asking what is the recommended age to buy long-term care insurance. There's not really a magical age to buy long-term care insurance, but there's several factors to keep in mind when considering long-term care. It's always best to buy it when you're healthy. Who knows if your client's going to be unhealthy in the future. So buy it now while they're healthy and they are insurable. I wish we knew what your client's future holds and what their health is going to be. So buy it now or buy it soon when they're healthy. And the younger you buy, the premiums are less expensive than they would be for older ages. There's not as much difference in the age premiums now as there used to be, but it's still, the sooner you buy it, the lower the premiums are going to be. And again, the key thing is to lock in that insurability. Received another question here. What happens if a couple has a shared care policy and they become divorced? Well, the companies will let you split that policy. You can split it, take off the cost of the shared care, and just each have your own individual policy. Okay? All right, now I'm going to move on. Let's talk about rate increases. Rate increases are a fact of life. The long-term care industry has received sort of a bad rap because of these rate increases and bad press, but there's a lot of things that we pay for in life that do go up. A lot of things that we buy every day or make sure we have that do have rate increases. The price of gas has increased from 2002 to 2012 by 158%. Health insurance premiums have increased since 2009 by 131%. Auto insurance premiums. In 2013, premiums increased over the rates from 2012 by 35%. Now, your clients are still buying auto insurance and health insurance, I'm pretty sure. They're still buying it even though they hope they will never use it, but they still have it there for the security. So when they're considering long-term care insurance, long-term care policy, yes, we hope that they will never use it, but they have it there in case they need it. And it does have rate increases, but not as big as these rate increases. Electricity rates have increased over 3 years, ending in 2013, by 37%. Now, your clients may come to you and say, hey, I've had a rate increase on my policy. But let's look at that a little bit further. That may not be such a bad thing, because if they've had coverage for several years, they have the security or peace of mind of knowing that they have that policy in place. What if they did get sick younger in life or early on? They have that coverage. They have that immediate pool of benefits versus if they're going to self-insure and they haven't built up that pool of benefits. When we talked about earlier in that example about self-insuring, we talked about they'd have that pool of $700,000 in 30 years. What happens if they become sick after 10 years? They wouldn't have that pool built up. They wouldn't have the policy in place for the security. So if they have a policy that's had a rate increase, they have the peace of mind of knowing that they have that in place. They've also secured their insurability. As I talked about earlier, buy the insurance while you're healthy. So you have that built in. Their health may change and may not become insurable, or they may have to pay a higher rate for a rated policy. So they've secured their insurability by purchasing that policy early. Every year the rates don't go up, they don't increase, you won. I think there's a feeling that in the general population that long-term care rates do go up every year. That is not a fact. Rates have been stable for many years. The insurance companies do have rate increases. Genworth's been in business for 40 years, and I think they've had 6 or 7 rate increases over those 40 years, and not all of those rate increases are on the same policy. So you may have a policy that's had a rate increase once in 20 years or maybe twice in 20 years. So they're not going to go up every year like many people think. And new policy today still costs more than an old policy with a rate increase. We do a lot of policy reviews for our clients and our advisors. We've never done a long-term care review where the rates on the old policy are higher than what it would cost them to replace with a new policy. Talking about policy reviews, here's a policy review that came in when we were preparing this webinar. So Maria and Norm, they have an existing long-term care policy they purchased in August of 2003. That policy had original benefits of $100 a day, a 90-day elimination period, an unlimited benefit period, and we bolded that unlimited benefit period in green because that is no longer available on new policies. So we can't even replace that. So we wanted to make sure you understand how important that is. And this policy had a 5% compound inflation. Their original premium, $1,328. So they came to us asking us to review this policy because, as I said, it had a rate increase. So today, that daily benefit has grown to $171 because of that 5% compound inflation. Still have the same elimination period, still have those unlimited benefits that cannot be replaced, 5% compound inflation. This policy had an 8% rate increase. The premium is now $1,435. So we looked at what it would cost to replace this policy today. Well, we can't really replace it today because we can't get a policy with the exact same benefits. We can get the daily benefit pretty much the same. The elimination period, we still can get a 90-day elimination period. But the longest benefit period now available with the companies that we work with is a 6-year benefit period. And if we added on shared care, that would give them 12 years to share between them. Because, again, we can't get that unlimited benefit period. Chances are most of your clients are not going to need unlimited benefits, but if they have it, we'd hate to replace it. There could be a need to have those, to have unlimited benefits, so you wouldn't want to recommend your client replace it because they might not need it. We can get the 5% compound inflation. The premium on this new policy, $8,371. So again, we would certainly recommend they hold on to that policy. And some of you are probably thinking, well, 8% rate increase, I've seen a lot higher. I've seen a lot of the rate increases I've seen lately have been around 8 to 12%. I do still see the higher rate increases, but a lot of them now they're trying to keep them down around the 10 or 12%. As we talked about, the industry is a new industry. It's a young industry. The long-term care industry is young, so they're trying to make changes on the policies and the benefits going forward so they won't have the highest rate increases that they've had, with the thought that even if they have to have rate increases in the future, they will be low. But we still are seeing some higher rate increases, so I wanted to show you a policy review with a higher rate increase. For an example, policy review on William. His policy was also bought in 2003, October 2003. Policy has a daily benefit of $150, a 50-day elimination period. I know that's unusual now. We don't see that, but his at a 50-day. Again, his also had the unlimited benefit period, 5% compound inflation, original premium $1,725. Well, William has received notice that his policy is going to have 3 rate increases. He's going to have a rate increase this year of 20% over the original premium, next year of 40%, and the year after of 60%. So if you look at the top line under benefits, his daily benefit is growing today to $244. Next year it'll be $256, and then 2016, $269. Still has that low elimination period of 50 days, unlimited benefits, 5% compound. So you can see on the very bottom there, you can see how his premium is going to go up over the next 3 years. This year, 2014, 2071, and then in 2015, $2,415, $16, and then 2016, $2,762. We're getting tongue-tied in all these numbers. So again, we looked at this policy for William to see how we could, if we could do any better for him, because a 60% rate increase, that's a large rate increase. So a new policy today, we're looking at a $240 daily benefit, had to go up to a 60-day elimination period. That's the closest we could get to a 50-day elimination. Again, we can't replace those unlimited benefits going with a 6-year benefit period. 5% compound inflation, new premium, $11,563. So he's better off to keep his old policy. But William also came back and said, okay, that's great, that's nice to know, but this new premium is still going to be a little high, a little hard for me on my budget. What would you recommend that I change on my existing policy? Well, we'd recommend he go to his company, his existing policy, existing company, and ask him if they can change that inflation option. Could he reduce it from 5% maybe down to 4% or 3%? If they will allow him to do that and keep the gains that his policy has already had, that would be nice. And when I say the gains, I mean for the last 11 years, his policy has had gains of 5% every year compounded. Most companies will let you keep that and then still reduce your inflation period option going forward. Another option he could consider would be to change the elimination period. He could increase the elimination period, maybe go up to 90 days or 180. Changing the elimination period does not make a big impact on the premium, but it make enough just that he the premium is more in his budget. And the other option would be to maybe change the unlimited benefit period. As I said earlier, good chance he won't need unlimited benefits. He probably needs maybe 5 or 6 year benefit period. So if he really wants to change the premium, reduce the premium, he could consider going down to a lower benefit period. I had a question here, what's the difference between compound and simple inflation? Compound inflation, 5% compound, it grows your policy by 5% the first year on the original benefit, and then every year after it goes 5% on the combined benefit so it's compounded. It grows on the new benefit every year. Versus simple, it'd be 5%. So on a $100 daily benefit, the 5% simple would be $5 every year because it's 5% of the original benefit. Okay. I had a quick question here. 10-pay, are there any 10-pay policies anymore? No, unfortunately, there are no more 10-pay policies on traditional long-term care insurance. The only option available now is continuous pay or lifetime pay premiums. If you're looking at a hybrid, if you wanted to consider, clients want to consider a hybrid policy, a hybrid life or a hybrid annuity, there are options to do 10-pay, single pay, and different types of options. Okay, now let's talk about changes in the long-term care industry. As I said earlier, the long-term care industry is always changing. It keeps me hopping, keeps me busy to try and keep up with everything. And this May, John Hancock came out with some changes. They kept their existing policy of existing product, but just made changes to that product. And across the board, they did a 15% rate increase. And this has been approved in the 40 compact states. And when you may ask, what are the 40 compact states? These are 40 states that have grouped together to make these universal changes. This means that the individual insurance companies don't have to go to each state individually to have these changes approved. And actually, now that I'm saying this, I think John Hancock just had these changes approved in about 3 or 4 more states as of yesterday. They lowered their maximum issue age from 79 down to 75. They've lowered the maximum daily benefit from 500 down to 400. In Florida, it'll still remain at 300. They removed their 10-year benefit period, so the longest benefit period now is 6 years. Remember earlier I said no longer any unlimited benefits, and since the companies have done away with unlimited benefits in the last year or two, they've done away with the 10-year, and John Hancock with the 6-year is the longest benefit period available with the 5 long-term care companies that we work with. They removed the survivorship and waiver of premium riders. These were 2 riders that we didn't show very often, so we weren't too upset about this. They've temporarily suspended their business in California. California is very cautious to approve changes. They're very conservative of what they approve for the residents, so it takes quite a while for a new product or changes to be approved in California. So John Hancock, for now, has taken their business out of California until they can get these changes approved. We expect they will be back in business in California in the near future. Genworth did this about a year or 2 ago, and now Genworth is back in California. And John Hancock is now requiring that all applicants have a paramed exam. Genworth made this change about a year or so ago, and now John Hancock is just catching up with that change. Previously, depending on client's age or how long it had been since they'd seen a doctor, whether they needed a paramed exam. But now, again, all applicants must have a paramed exam. Now, Genworth made some changes this summer, and their changes are kind of similar to John Hancock's. They went down a maximum daily benefit of $300 a day, which was down from $400. Future purchase option they lowered to 3%. Previously, it was 5%. So this meant if your client had a policy with a future purchase option and they were given the option to increase their coverage every 3 years without going through underwriting, and they could have used to be able to increase it by 5%. Now the max they can increase it is 3%. Their longest benefit period is now 5 years. Again, they had a 10-year, and they've gone down to 5 years, their longest, formerly 10-year. All home care services require an agency. In the past, Genworth was one of few companies that would allow paid care to be received by friends and neighbors. And what I mean by this, by paid care, is you could have a friend or a neighbor or a family member take care of you, but, well, I'm sorry, I shouldn't have said family member. You could have a friend or a neighbor take care of you and be paid or be reimbursed for this care by Genworth. Now Genworth has changed this. They require that any care be provided through an agency. So it have to be a certified and licensed caregiver. No other company that we work with, or I haven't heard of any other company that allows a friend or neighbor to provide care, and none of them definitely allow a family member to provide care. Genworth has added in the option of a 2% compound inflation rider, so now they have 2, 3, 4, and 5% compound inflation. And over the last couple of years, the insurance companies, and Genworth in particular, has said that they are going to consider family history in the underwriting process. And up until now, they haven't given us sort of any charts or guidelines on how this family history would affect the underwriting. So what they've come up with now, or what they're giving us now, is if a family member has been diagnosed with coronary artery disease prior to age 60, then the proposed insured at best could qualify for preferred rates. And I don't know if I clarified this. What I mean is if any parent has been diagnosed with coronary artery disease. It doesn't matter about siblings. It's just a parent. If a parent has been diagnosed with dementia prior to age 70, if it's one parent, the best that they could get would be preferred. If both parents have been diagnosed with dementia prior to age 70, the best class would be select. And select is what most clients qualify for. Select is kind of like the middle of the road. And when we quote, that's what we generally quote is select. So it's not a big detriment. What are these? How have these changes impacted the Genworth's rates? Well, in the past, when we quoted, as I said, we work with 5 companies. I would say about 80% of the time, Genworth had the lowest rates. This is no longer the case. Genworth is not the lowest. And then we saw the biggest rate increases for Genworth on their 5% compound. Policies that have the 5% compound added onto it. What we're seeing is now Genworth's rates are about 40–60% higher than other companies when we're looking at policies with the 5% compound inflation. They're still competitive at 3% when we're quoting policies with 3% compound. They are not the lowest, but they are competitive. They're more in line with everybody else. And one of the reasons we think Genworth is making all these changes, or has made all these changes, is they don't always want to be the lowest. It's kind of like you're a neighborhood gas station. They don't always want to be the ones with the lowest rates. So they're trying to get in line with everybody else. And what we've seen is the older clients are most affected by these rates, or most impacted by these rates. We've seen the biggest rate increases for clients in their late 60s, late 70s, or I'm sorry, in their 70s. So the biggest rate increases have been on that group of people. I've got a question here that just came in asking if these changes impact current policies. No, I'm sorry, I should have explained further. These changes that I'm talking about with John Hancock and Genworth are changes on new policies going forward. There's sort of two different types of rate increases. There's rate increases on in-force policies. That's not what I'm talking about here. I'm talking about new policies going forward. So if your client were to purchase a policy today, this is how that policy would be impacted. I'm not talking about your clients that purchased a policy last year. So again, these are changes in products. And I didn't mention Genworth, with these changes, have come out with their new product. John Hancock just made changes to their existing product. Genworth came out with new changes. Okay. Just had a question asking, what is a paramed exam? A paramed exam is a medical exam performed or done usually in the proposed insured's home or office, and it's done by a paramed nurse. And they take blood, urine, blood pressure, height, weight, and ask many medical questions. So it's very similar to what a paramed exam that your clients would go through for life insurance or disability insurance. With a long-term care paramed exam, there would be more emphasis on cognitive abilities and memory, things like that. Okay. Let me see if I have some other questions. A lot of questions here, hard to get them all in right now, so I'm going to finish up, and then if I have some time, I'll try and get to some of these questions. So today we talked about several different things. We talked about whether your client should self-insure or purchase a long-term care policy. If your client is independently wealthy or has a lot of assets set aside, self-insure may be the way for them to go. But if your client is borderline, if a long-term care event would impact them greatly, they may want to consider the long-term care policy. And then if they consider the policy, we looked at the policy choices, what they have to choose from, the different benefits, and how that could impact the premium. We talked about females and long-term care, how it affects them, and what the chances are a female may end up alone at the time that they need care. Talked about rate increases, how that affects premiums, and also how rate increases are sort of a fact of life with other products. And then we ended up by talking about changes in the industry. So these are all very important, but the bottom line is I want to leave you with a quote by Rosalind Carter. Bottom line is I want you to realize how much a long-term care event could affect the family or everybody involved or anybody close to the care recipient. So there are four, according to Rosalind Carter, there are four kinds of people in this world. Those who have been caregivers, those who currently are caregivers, those who will be caregivers, and those who will need caregivers. So if you have not been a caregiver yourself or somebody in your family hasn't, a good chance that in the near future you or a family member or a friend or a neighbor will face this, and hopefully they will be prepared. Wanted to make you aware of some tools that are available on our website that will help you when you're planning for long-term care and your discussions with your clients. On our website, we have e-brochures. A couple of them talk about traditional long-term care, and then there's two for hybrids, hybrid annuity, hybrid life. There is a nice insurance glossary that's been put together and placed on our website to help your clients with terminology and acronyms. Quote request, you can go on our website and request a long-term care quote, and along with your term life, disability, annuities. And it's detailed. We ask a lot of detailed questions for the most accurate quote up front. And if you want to know the cost of care in your area or your client's area, give me a call. Here I am. Give me a call and I'll help you with that. Low Load Insurance presents at a lot of different webinars and conferences around the country. The next webinar coming up, Mark's going to present to the ACP members on the 17th of this month. And then Jerry and Mark will be at the NAPA conference in the fall, and I believe Mark is presenting there. And then Jerry and I will be at the ACP conference in November, and we will also present there. The newest and most exciting thing to happen lately here at Low Load Insurance Services is we have a new logo. And probably many of you have received emails with this new logo. We're excited about this. It's been 16 years since we've been in business, and we decided it was just time for an update. And we're also working on a new website. We wanted to have a new website up to date and give you and your clients the latest technology. So stay tuned on that. We're working hard on that. And what are top 10 things that make Low Load different? Number one is we give these monthly webinars that you're listening to. The next one in October is on business insurance. November, we're going to talk about hybrids, and then finish up the year by talking about 1035 exchange. Here's some other list of things that make us different from everybody else. We're not your competition. These are all important, but number 5 I think is very important. We pre-underwrite to avoid surprises. You and your clients don't like surprises, and neither do we. So we want to prepare for that and pre-underwrite. And we sponsor a lot of different groups. Here's an example of the different groups that we sponsor: NAFA, Garrett, XY Planning, NAFA Genesis. So as you see, we do a lot of presentations and sponsor a lot of groups. And we have product specialists in the different lines: life, disability, long-term care, annuities. I'm the long-term care specialist. Kathy is the disability specialist. Jerry is our annuity specialist. Jerry also is the main point for life insurance, but Kathy and I also back him up on the term life insurance. And we keep you in the loop with our AIM system, our AIM messages. We keep you informed on quotes as they're going out, and then during the underwriting process and the application process, we keep you informed with our AIM messages. And we also keep you informed once the policy is enforced with our APE, our advanced premium email, and then our note system, our notification of term expiration. We have a few minutes. I have a few questions here that I'll try and take. Please give me a second here to read them. Okay, it's asking, one of the questions is, do you plan for 3 years all in skilled care, or assume some care on home and assisted living care? How does this impact cost projections? Yes, we do plan for some care in your home first. Most people like to stay in their home as long as they can, so we would assume that they want to plan on receiving care for a year or two in their home. So when I talked earlier about 3 years, the average length of stay in a nursing home, or under 3 years, the average length of stay in a nursing home, with a 3-year, if they wanted to ensure that they have a pool of benefits set aside for home health care too, they may want to go for the longer benefit period of 4 years or 5 years. When we quote for an individual, we usually recommend a 4 or 5 year benefit period, keeping that in mind that they may want to be in their home for a year or two before they go into a nursing home. But then when we talk about a couple and we look at 3 years with the shared care, we're sort of hedging our bets that between the two of them, they won't both need 3 years in the nursing home. So with that flexibility, maybe one of them will need 1 or 2 years at home and then 1 or 2 years in the nursing home. So if you were to get a very rich policy, remember back at that Cadillac policy I showed you, we went with a 5-year benefit period with the shared care. So that gives them a year or two to use at home or assisted living before they may go into the nursing home. Okay, we've run out of time, so thank you very much, everybody, for attending. We've wrapped it up. If you have questions that I haven't answered, please give me a call, and I'll be happy to answer those questions for you. Thank you very much.